Today we are going to see the concept of double entry system. The concept of double entry, the concept of double entry system states that for every transaction there are two entries, that is, one account will be debited and the other one will be credited. So, debit, we can write down DR. We debit any item which come into the business, and then CR means credit. We credit any item going out from the business. So, yes, dear students, we are going to see the concept of double entry. The concept of double entry system states that for every transaction there are two entries, that is, one account will be debited and the other account will be credited. So we debit any item which come into the business and we credit any item which goes out from the business. So, dear students, in any business transaction there are two items. One item coming into the business, what we call debit, and there are the other item going out from the business from the same transaction, we say credit. So in any transaction there are two entries, there are two items. One item is coming into the business, we call it debit, and the other item going out from the business, we call it credit. So, for example, purchase motor van Focus. Assuming you are purchasing the motor van, purchase motor van Focus. What is coming into the business? Motor van. Therefore, we debit motor van account. What is going out from the business? Cash. Therefore, we credit the cash account. So this is the concept of double entry is very easy. You just have to use your logic. Item coming into the business, you have to debit, and item going out from the business, you have to credit. For example, sold goods on credit to XYZ. Sold goods on credit to XYZ. So what is going out? Goods. Therefore, we have to credit. But we don't have goods account, we credit sales. And then we debit XYZ. If we know one debit, the other ones come automatically. Now, sold equipment for cash. What is going out? Equipment, credit equipment, debit cash. Paid wages by cash. What is going out? Cash, credit wages, credit cash, debit wages. Receive cash from ABC. What we are obtaining? Cash, debit cash, credit ABC. So very easy. You just have to take into account which item is coming into the business, we have to debit, and item going out from the business, we have to credit. Let's see this one. Purchase, let's say January 2. Purchase motor van Focus. Purchase motor van Focus $18,000. So we just have to state the double entry, the account to be debited and the account to be credited. Purchase motor van for cash. What we are obtaining? We are obtaining motor van, therefore debit motor van account, and then what is going out? Cash, we credit cash account. January 2. January 3. Sold equipment for cash $15,000. So what is going out? Equipment is going out, credit equipment account. What is coming into the business? Cash, debit cash account. Very easy. You just have to take into account which item is coming to the business, you have to debit, and which item going out from the business, you have to credit. January 5. Paid cash to NBC $10,000. Paid. What is going out? Cash is going out, therefore credit cash, and then we debit NBC. If you know one double entry, if we know the credit, then the debit comes automatically. If we know the debit, then the credit comes automatically. January 6. Receive cash from Robbins $16,000. So what we are receiving? Cash, debit cash, and then we credit Robbins. So very easy. We just have to take into account which item is coming to the business, we have to debit, and item going out from the business, we have to credit. January 7. Paid cash to suppliers $8,000. So what is going out? We are paying cash. Cash is going out, credit cash account, and then we have to debit the suppliers account. If we know one double entry, the other ones come automatically. January 8. Sold goods for cash $6 million. Sold goods. What is going out? Goods. We credit goods, but we don't have goods account. We credit sales account, and then we have to debit cash account. January 9. Receive check. Receive check from Bucks $10 million. Therefore, we debit what we are receiving, check, debit check, but we don't have, we have to write down bank account, and then we credit Bucks. Very easy. January 10. Paid cash to James $8 million. Paid cash to James. What is going out? Cash, credit cash, debit James. So here we are so far concerning the concept of double entry. So in any business transaction, we have two items. One item coming into the business, we call it debit, and the other item going out from the business, we call it credit. So you just have to take into account which item is coming into the business, you have to debit, and which item is going out from the business, you have to credit. For example, purchase building for cash what we are receiving, building, debit building, credit cash. Sold furniture, for cash. What is going out, furniture, therefore credit furniture, debit cash. So very easy. You just have to use your logical sense just to see which item is coming into the business you have to debit, and which item is going out from the business we have to credit. Thank you very much for your attention.